All right, Saagar, what are you looking at?
Well, several months ago, if you started talking about a recession, people would have looked at you like you were crazy. Yes, inflation's sky high. Cash was cheap. The Federal Reserve policies and corporate price gouging throughout 2021 was floating the stock market, subsidizing cheap cash to fuel investment, crypto markets, housing prices, all asset goods. The best off in this country were never better off in that very specific moment in time, which really, as a vibe, culminated in Elon Musk's offer to buy Twitter for nearly $40 billion. Things pretty much went south a few weeks after that. Inflation finally caught up to the market. The Fed bumped rates. Stocks have never recovered. One industry that forewarned the broader woes that we know well today was Silicon Valley. It's why we continue to watch it very closely, because the first person that presciently even warned me that a recession was coming were those involved in tech. I vividly recall I had a conversation with venture capitalist David Sacks weeks before the market crashed, who described to me in detail how private market valuations were tanking as a result of Fed policy and how it was going to trigger a broader downturn. All of it makes some intuitive sense. Public markets are by definition less risky than private ones. Private companies, and specifically startups, are the most reliant both on broader market conditions, but on availability of capital to further their life so that macro policy has a big effect on them, as opposed to, say, a public company with robust cash flow and an established market. So, as we continue to play the are we in a recession game or not, spent some time in the last week going and doing some research. The results are really grim. This week is going to be critical for Recession Watch. Big tech companies are going to report earnings. Already, there are major blinking red signs. Snapchat, which was a harbinger of the last crash, crashed 25%. Additionally, in a single day, after reporting that a massive drop in advertising earnings on Friday. Meanwhile, Netflix, Amazon, Microsoft, Google, Facebook, Apple, all are spinning and setting market expectations ahead of earnings to be released this week, with PR phrases like uncertainties related to the operating environment. Apple, the world's largest tech company, one of the most valuable public companies on earth, has decided to massively slow down hiring and investment, which tanked the market on their news. The reason that the behavior of these big firms matter is threefold. If things are bad there, then imagine being a startup. How are you supposed to make money when Amazon is barely making money? How are you supposed to borrow money on a promise of valuation when the businesses that are worth trillions of dollars are having trouble keeping their stock price? Number two, these major companies have been big buyers, investors, and backers of other startups. Each of these companies acquires a healthy amount of tech startups every year, often using their stock price and widely available cash to do so. If that dries up, a major market player dries up as well. Number three, and probably most important for all of us, is tech is just really big. The tech sector in America for nearly 2 decades has been thought of as bulletproof. They print money, they have virtual economic monopolies. Why not invest in them? This has led to the gradual overweighting of tech in nearly all portfolios, including the traditional stock indices. So let's say specifically the S&P 500. It's always talked about for amateur investors. Put your money in the S&P 500. Returns an average of X% a year, meaning in the long term, you're going to make money. Now, that's still probably sound advice in the long run. But in the near term, consider what it means. 20% of the S&P 500's market cap alone is just 5 companies: Google, Facebook, Microsoft, Apple, and Amazon. But dig deeper, many of the companies within the S&P 500, which is technically only 20% of the index, actually adds up to nearly 40% when you consider overall tech exposure. That means that tech has a massive impact on the overall US public markets, which of course, look, you may not own stocks, or you may not even have, or you may just have a basic 401k, but you will still be affected if there is a bigger crash. 2008 taught us all about the availability of money, about how much valuation impacts overall behavior, the loaning of cash, and the tremendous amount of wealth that is generated in financialization, and things have frankly only gotten worse since then. Ballooning valuations and stock prices have probably increased the exposure of the overall economy since then. Slight downturns in tech have a huge impact on everything: overall stock market, people's retirement portfolios, Fed policy, to how Congress thinks about how should they respond. And another key recession indicator has been the housing market. While we were off, we highlighted how the cancellation rate on housing purchases is spiking across the nation. But I'll also have my eye on the luxury market. Again, that was a major harbinger of things to come when the initial boom happened. Here, we see the same thing. In real estate markets that are fueled by money in tech sector, we are seeing an overnight crash on the luxury market. The luxury market is in some ways a better peg as to how the overall assets are doing, because most high-end transactions have nothing to do with mortgage rates. They deal in straight-up cash. Cash available availability to luxury buyers, especially in tech, comes in two forms: loans against assets and then asset sales. So tech stocks are sky high. It's really easy. You take a loan based upon the massive value of your technology holdings, you use that to pay for the house, or you sell some portion of your assets and you use that to pay for your house. Either way, it's simple, efficient transaction. But the crash has led to a dry up of such offers and overnight properties. There's a $3.5 million luxury penthouse in San Francisco. It would have sold in 24 hours 6 months ago. They cannot even get one phone call of an interested buyer in 3 weeks. Furthermore, the luxury market may actually be trending in the wrong direction. When a lot of people in tech have terrible asset prices in stock, what do they turn to? Real estate. So the luxury real estate that they acquired ends up being last major asset that they hold, which then leads them to try and sell while the price remains possibly high. Well, it doesn't take a genius to figure out this could induce all the prices to drop if a critical mass of people all decide to sell at once, which then leads to decline in the price of assets, which is going to impact you. So the reason I'm spending so much time here is because it's really critical to understand the major arrangements of our lives are really not up to us at all. How your small business does, as we have found out also, is only so much in your control. Most of it lies with the Fed, with Wall Street, with other players who are accountable to no one. Small things like changes in luxury markets or advertising dollars can nuke entire businesses overnight through a butterfly effect. Pay close attention to all of these things that are going on because they could have come to have a big impact on your ability to live your life. Personally, I'm hoping for the best, but things are not trending good in the right direction for right now. I think that's a major lesson I've been taking away recently.
Cable news is ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.